In this video, we will learn relation between economy and stock market. When the economy is booming, everyone gets a job. Having a job means having a steady income flow every month, which means now people can afford to buy or consume. When the purchasing power of the consumer increases, or in other words, the demand increases. To keep up with the demand, business increases supply by producing more products or by offering more services. Now, this leads to two things. Number one, now more and more businesses become profitable as the sales starts to take off. Number two, to support the increased production, now companies start to hire more people. Which means, creation of more jobs. Now it creates a self-sustaining cycle. So when the economy is booming, we get to see a bull market. Now most companies are making tons of money. Investors are now willing to pay more to purchase a piece of ownership in those profitable companies. On the other hand, when the economy tanks, it impacts people most. People start to lose jobs. Their purchase power decreases. As the purchasing power of consumers decreases, or in other words, demand decreases. Now businesses need to cut supply. As they reduce production, two things happen. Number one, the profit of the business starts to shrink. As profit goes down, investors become more worried about their investment. They start to pull out money by selling shares. This selling pressure further leads to a crash in the share price, which eventually becomes the picture for most companies. Number two, more and more people start losing their jobs. It creates another destructive cycle. In most cases, to break this bear cycle, as we have mentioned earlier, our central bank takes numerous steps, as well our government. So in a way, we can say share market is highly connected to the economy. Even we can say share market is the barometer of the economy. But does it mean all the time, share market reflects the economy? Not necessarily. There are so many times the stock market crashes when the economy is doing pretty well. And then, there are times when the bull market forms out of nowhere, even when the economy is struggling. Sometimes there is a reason behind this discrepancy, sometimes it's purely driven by human emotion. It's impossible and unnecessary to cover every possible reason, but surely we will try to cover some important ground. One of the most popular explanations is, the stock market is forward-looking. This means, investors when they invest, are more worried about what will happen to their investment in the future. For example, let's say a company worth 100 rupees is earning only 7 rupees now. Even if you do some research of your own, you will find some banks are offering more than 7% return. Then why should you invest in the company? When the bank is clearly the safer option, investing as a company comes with additional risk. The company can fail tomorrow, but the bank won't. Even if the bank fails, you have the sovereign guarantee from the government. Investing in a company is more attractive, because with time the earning will increase. It won't stay at 7 rupees. In some years it will become double. And the great part is, as the valuation of a business depends on its earnings, so the valuation will follow. So you can expect the share price to touch 200 rupees when your company's earnings increase to 14 rupees. So as you can see, investor looks for the future when they are investing. So if they anticipate that in future the profit might go down, they can start pulling off their investment, thus creating a crash. The same analogy is applicable when we see a bull market in a bad economic condition. It's simply because investors think, in the future things will only get better, profit will for sure increase. But not necessarily, Every time the same analogy explains all discrepancies. There are times when some bull market or in cases bear market too is purely driven by human emotions. Now, as we know, the economy can be affected by various factors, and it's impossible for us to anticipate everything. But there is a good news: to make money we not necessarily need to see the future. We will teach you how. If you liked our video, please like and subscribe. Also, we have a course on technical analysis, where you can learn directly from professional traders. With their guidance, you can become a professional trader in no time. Thanks for watching our video.